Welcome to Financial Friday. Today's concept is going to be pretty simple, actually. I don't see this video or podcast taking particularly long. And the nice thing about it is, hopefully, I don't think anyone will require any visuals to be able to process this. And the concept is simply, I don't know if there's already a technical term out there for it. There may very well be, but I prefer to think of it as guaranteed interest rate. And the way we're going to apply this is whatever your highest guaranteed interest rate should be your highest priority. And what I mean by that is a lot of people get themselves into situations where they're wondering what they should prioritize first. So, for example, what account should I put most of my money into? Do I prioritize paying back this loan or investing it? And simply put, you put most of your focus and money into whatever is guaranteed to have the highest interest rate. So for example, if you were to have a hypothetical, that's a little weird. So if you have a hypothetical credit card debt of, let's just say $1,000, right? And you are paying, again, hypothetical, 10% in interest every month. So with $1,000, right, the next month you are paying, or your the amount of money you owe back to the bank is no longer $1,000. It is now $1,100, right? And it's only going to increase by 10% every following month after that. On the other hand, if let's say you are investing money, right? And let's say you have $1,000 in your brokerage account. If you last month, say you got really lucky or you planned out a trade very well and you made, let's say, 20% last month, you made $200 off the 1,000 you have in your brokerage account, it may seem that it's a better idea to keep your money in your brokerage and not pay off this credit card debt, right? The problem with that is that you aren't guaranteed to have 20% gains on your brokerage account. Next month, the market may fall flat. Whatever you're invested in may fall flat. It may even lose value. The trading plan that you have, depending on how long you've been trading, may not work out all the time. What is definitely sure is that you are going to increase your debt by, in this scenario, 10% every month. And so if next month you can't keep up at least 10% gains per month on your brokerage account, you're losing money, right? You're just straight up losing money. So what you are your best bet in terms of getting away with a good situation safely is paying off that credit card debt, because you are guaranteed to have, just looking at these two accounts and accounting for nothing else, a net positive of, $100, right? Hopefully you have that $1,200 from your brokerage, you pull it out, you pay off the $1,100 in debt from your credit card, and you're left with $100. And that $100 is just hopefully going to sit in your checking account. If you want to invest it, that's fine. But you have $100 to work with and no debt that's going to be building. On the other hand, if you choose to play it risky, there is a very good chance that you get yourself into an insurmountable debt, right? It's possible that your debt just keeps climbing. Your brokerage account may not grow and may completely vanish, actually, if you don't play your cards right. So I would just say that a good rule of thumb is figure out which accounts are guaranteed, and typically debt is guaranteed. And that's why financial institutions are able to do what they do, right? When they offer you great rewards and interest rates, blah, blah, blah. It may seem like they're offering you a lot, but they are guaranteed to get even more back. and all these like accounts and instruments that we as just general mainstream consumers, not big institutions, it's hard for us to get guaranteed returns. It's hard for us to pull together enough resources to diversify into a lot of different industries and investments to guarantee and smooth out our risk. But what we are guaranteed to face is, these high interest rates on things such as student loan, auto loans, mortgage, whatever. So when in doubt, wipe out your debt first, then go into these instruments that make money. So mostly the ways that we have to get guaranteed money, the guaranteed money is usually pretty low. If you're looking at CDs, if you're looking at savings accounts, the interest rates are incredibly low. They're usually 1% or lower, whereas, the rates that you're facing on your loans are going to be much, much higher typically than that, right? Another thing is, kind of keeping on the same track, but looking at just, let's say different forms of debt. If you're able to refinance or refocus your debt, right? If you can, let's say you have, a student loan debt. Not sure what the interest rates are right now because I'm not a student. But let's just say for the hell of it that that's at 10%. Whereas the credit card that you have, let's say the interest rate on that is 20% per year, per month. Doesn't matter. It just has to be for the same time period. Then if possible, right, you choose the one with the lower interest rate, in this case, student debt or student loan debt, pay that off. Oh, wait, sorry. How did I set this up? Student loan debt was 10%, credit card was 20%. Sorry, you pay off your credit card debt first so it doesn't keep building as quickly, and funnel it all into your student loan debt so the interest is building much slower. Anyways, pretty simple concept, I think. Keep your guaranteed interest rates in your favor, right? So whatever positive ones you have, try to channel that into the higher ones. For your debt, try to channel that into your lower interest rates, and make sure that you are really conscious of what is guaranteed returns and what is not. Typically, debt is guaranteed. Gains are not so much. So focus on getting rid of your debt first, then focus on, gaining wealth, accumulating capital afterwards. That's it for today. Thank you for listening on Financial Friday. Bye.